Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is James Gellert, CEO of RapidRatings, to discuss how to measure the health and financials on private and public companies as a result of the COVID-19 beyond traditional analysis. James, it's great to have you with us. Welcome to Trade Talks.
Thank you, Jill. Good to be here.
Give us a high-level overview of RapidRatings.
So we're a fintech company, a SaaS business. We provide predictive analytics on the financial health of public and private companies. We have under coverage around 150 million companies around the world. We provide ratings in depth through our financial health rating system on companies in 140 countries. And we do this in significant depth by looking through the financial statements to compare companies to now 14 million company years worth of financial data over the last 40 years. So it's very in-depth analysis that we provide for institutional investors, banks and insurance companies, and corporations looking to evaluate their customer base, trading partners, or in large part their supply chain members.
Well, analysts track equities to understand the impact of COVID-19, but need a different lens into financial and core health measures to understand what's happening below the surface. What does RapidRatings provide that differentiates the data that's already out there?
So we're rating the companies themselves, not the securities. So we're multi-asset class in nature. And we don't include any market pricing in our evaluations. It's strictly looking at the financials. So there's no volatility associated with the ratings based on what the market is doing on any given day, whether it's the whole market or individual stocks. But we're looking in depth at the financials, both providing a longer term score called the core health score, which is evaluating how the operational efficiencies and the core business of a company is doing, and what we call the financial health. And the financial health rating is assessing the core health, but looked at for the 1 year resiliency. So what kind of liquidity, leveraging, earnings performance of a company is making it strong or weak in the short term. So we're amassing a tremendous amount of data in this process. So we're able to see the trends of public and private companies and the differences in the dynamics between their core healths and their financial health changes. And with the COVID crisis, we're seeing a significant amount of change and a tremendous amount of concern when you go into a lot of the subcategories of the major industries. And this is something that is going to take a long time to work through as these problems that have emerged because of the COVID crisis work their way through, either to kill some companies or hurt others. And of course, there are plenty that are surviving and thriving through this. So it's really being able to understand the differences among all of those.
Yeah, and that's a great point that you make, because the pandemic really has had a compound effect on all companies, even while some are benefiting from the increased demand, like work from home stocks, for example, or companies. Many have had to tackle a baseline of issues. So what are some of those issues, and how are you able to see the impact at RapidRatings?
Well, I think of your question really in two ways. One is what companies themselves have to be evaluating, and of course others looking at those companies should be making sure those companies are evaluating. And those are things like, what has happened to the core business and how has it been affected by the COVID crisis? The core health score is that indicator. How well is the cost structure efficiency and the operational efficiency of the company continuing and surviving through this time? But the other is understanding what the shorter term problems are or benefits. So we know that a tremendous amount of corporate leverage is in the market, and that has been increasing. Companies have been getting as liquid as possible, hitting bank lines and hitting the bond market, and in some cases issuing secondaries or IPOing. So this capital is bolstering the shorter term prospects for companies. But if the financial health rating is staying stronger, but the core health is deteriorating, that liquidity only goes so far. And so each company needs to understand the dynamics between the long-term potential for their business and the short-term dynamics, as does the market. And then the other part of that is really what's happening to their supply chains, because companies are interdependent. And companies of all sizes have suppliers that they rely on to be able to produce their goods and services. And with deterioration going all the way up the supply chain, that means there are companies that may seem okay today, but in 6 months, 12 months, 36 months out, they may have significant problems delivering because of the evolving issues among the companies in their supply chain. So given the changes that we see in financial health, all companies need to be acutely aware of their own supply chains and how their own financial health is tracking.
So are you able to identify the effects in advance?
We are. Look, pre-existing conditions happen to companies just like they happen to people. Historically, companies don't fail if they're doing well. They fail when they've been deteriorating or they're weakening and they have some pre-existing condition. And the FHR is often considered by many to be an indicator of whether companies can withstand a shock. And we are in the biggest shock that most companies have ever experienced in their time. So historically, over the last 20 years, over 90% of companies that have failed, we've had rated at 40 and below on our 100-point scale, which means high risk and very high risk. It's a very high accuracy rate. But again, it's about being able to identify companies that are deteriorating, to be able to do something about them. And that's really about being able to assess pre-existing conditions.
So James, how do institutional investors use this kind of data?
Well, they need to understand the companies that they're investing in and these dynamics, the longer term and the shorter term. They can't just be looking at what the securities of those companies are doing at any one point in time. So that's one. They really need to understand that. And because we have so many of the largest companies in the world using us to evaluate their suppliers, they're giving more business to, in many cases, the companies that are stronger rated. So understanding if you're investing in a company that has a high FHR, that probably is good for them, for their prospects commercially. And the weaker ratings, weaker rated companies may have challenges, but they're challenges they need to address. I think that really the biggest thing that comes to mind is institutional investors, in my mind, don't do enough to probe the public companies that they invest in on what their supply chain risk management programs are. And the investor relations community kind of skirts over this, other than to say things like, well, we're moving into or out of regions of risk, as opposed to institutional investors making it a critical disclosure item and making sure that the CFOs and the finance groups of companies are closely intertwined with the procurement and the supply chain sides to be able to identify exactly what and how sophisticated their risk management programs are of their supply chains. And if they don't do that over the next 2 years, we're going to see an awful lot of problems that could have been avoided.
Yeah, that's a really good point. So to wrap up, James, what happens if a company has a poor rating? Does that mean that they're going to lose investors or businesses, or is that an opportunity for them to right size their supply chain and logistics?
Well, a weaker rating is really a call to action, and it's a point of discussion. And what we find in supply chain is most companies don't want to change out their suppliers, just like most investors don't necessarily want to exit an investment unless it's just a momentum play. So the weaker rating is an identification of areas where a company needs to strengthen. And for supply chain and customer relationships, that means a company is working with their supplier more in a collaborative way to understand what challenges they may have. An institutional investor can choose to invest in or not a weaker company, but if they like the longer term prospects of it, the core health is strong, but the financial health rating may be weaker, that's an opportunity to see what those short-term strategies are that the company is employing to strengthen itself on a strong base. But of course, if it's weak in both, that's an opportunity to look for somewhere else to put your money.
All right, James, thanks for joining us on Trade Talks.
Thanks, Jill.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.